Good day everyone, I am Rosemary Petere and I will going to discuss to you the chapter 10 of the financial markets entitled Mortgage Market and Derivatives. It consists of two parts. The part 1 is the mortgage market and the part 2 is derivatives. But I will only going to discuss to you the part 1 because Mr. Pael will continue the part 2. So, let's start. Part 1, Mortgage Market. Let us know what are mortgages. So it is a long-term loan secured by real estate. Both individuals and businesses obtain mortgages loans to finance real estate purchases. Let's go to the characteristics of the residential mortgage. The modern mortgage lender has continued to refine the long-term loan to make it desirable to borrowers. Even in the past 20 years, both the nature of the lenders and the instruments have undergone substantial changes. One of the biggest changes is the development of an active secondary market for mortgage contracts. The mortgage market has become very competitive in recent years. As a result of the competition for mortgage loans, borrowers can choose from a variety of terms and options. So it has six characteristics, and the first characteristics is the mortgage interest rate. So, it has three important factors that affect the interest rate on the loan. The first factor is the current long-term market rates. So, these are determined by the supply of demand for long-term funds, which are in turn affected by a number of global, national, and regional factors. Mortgages rate tend to stay above the less risky treasury bonds most of the time, but tend to track along with them. The second factor is the term or life of the mortgage. Generally, long-term mortgages have higher interest rates than short-term mortgages. The usual mortgage lifetime is 15 or 30 years because interest rate risk falls as a term to maturity decreases. The interest rate on the 15 years will be substantially less than on the 30-year loan. The third factor is the number of discount points paid, or simply points, are interest payments made at the beginning of a loan. Let's go to the second characteristic, the loan terms. Mortgage loan contracts contain may legal and financial terms, most of which protect the lender from financial loss. Collateral. One characteristic common to mortgage loans is the requirement that collateral, usually the real estate being the finance, be pledged as security. Down payment. To obtain a mortgage loan, the lender also requires the borrower to make a down payment on the property, that is, to pay the portion of the purchase price. Private Mortgage Insurance, or DPMI, is an insurance policy that guarantees to make up any discrepancy between the value of the property and the loan amount should a default occur. Lastly, borrower qualifications. Before granting a mortgage loan, of course, the lender will determine whether the borrower qualifies for it. Amortization of mortgage loan. So, borrowers generally agree to pay a monthly amount of principal and interest that will be fully amortized by its maturity. So, what does this mean, fully amortized? So, means that the payment will pay off the outstanding indebtedness by the time the loan matures. Type of mortgages loans. So, there are 10 types, but I will only enumerate it. So, the first one is the conventional mortgages, insured mortgages, fixed rate mortgages, adjustable rate mortgages, graduated payment mortgages, growing equity mortgages, shared appreciation mortgage, equity participating mortgages, second mortgages, and reverse annuity mortgages. Let's proceed to securitization of mortgages. Intermediaries face several problems when trying to sell mortgages to the secondary market. That is, lenders selling the loans to another investor. These problems are: mortgages are usually too small to be wholesome instruments. Mortgages are not standardized. They have different terms to maturity, interest rates, and contract terms. Thus, it is difficult to bundle a large number of mortgages together, and mortgages loans are relatively costly service. The lenders must collect monthly payments, often advances payment of property taxes and insurance premiums and service reserve accounts. Lastly, mortgages have a known default risk. Investors in mortgages do not want to spend a lot of time and effort in evaluating the credit of borrowers. The above problems inspire the creation of mortgage-backed security. So, impact of securitized mortgage on the mortgage. Mortgage-backed security, also called securities mortgages, have been growing in popularity in recent years as institutional investors look for appreciative investment opportunities that compete for funds with government note funds, corporate bonds, and stock. Also, securitized mortgage are low-risk securities that have higher yield than comparable government bond and attract funds from around the world. What benefits and derive from securitized mortgage? SM. So, SM has reduced the problem and risks caused by regional lending institution, sensitivity to local economic fluctuation. Also, borrowers now have access to a national capital market. The third, investors can enjoying the low risk and long-term nature of investing in mortgages without having to service the loan. Lastly, mortgages rates are now open to national and international influences. As a consequence, mortgages rates are more volatile than they were in the past. That's all from mortgage market. Thank you.
Good day, everyone. This is Francis, your second presenter for this chapter. So, we will tackle about derivatives. So, what is derivative? It is a contract whose value is based on something else or any security whose value is determined by or derived from the value of another assets. So, the main purpose of a derivative is to mitigate the risk of an existing contract or business or a contract between two parties. So there are two examples of derivatives. So first is future contracts. It's an agreement between a seller and a buyer that requires the seller to deliver a particular commodity at a designated future date at a predetermined price. So the second is the forward contract. So a forward contract is an agreement between two parties to buy or sell an asset at a specified price and on a predefined date. Sometimes, some people call it uh, bet because of the uncertainties, and it is called forward contracts because the transaction happens on a later date. So there are some distinction between forward contracts and a future contracts. So first is a forward contract calls for delivery on a specified date, whereas a future contract permits the seller to decide later which specific date within the specified month will be delivery date. Second, unlike a future contract, a forward contract usually is not traded on a market exchange. And the third, unlike a future contract, a forward contract does not call for a daily cash settlement for price, exchange, and underlying contract. Gains and losses on forward contracts are paid only when at are closed out. So options. Options gives its holder the right either to buy or sell an instrument, say a treasury bill at a specified price and within a given time and period. Foreign loans, foreign currency futures. Foreign loans frequently are dominated in the currency of the lender. So next is interest rate swaps. Over 70% of the derivatives are interest rate swaps. This contract exchanged fixed interest payments for floating rates payments or vice versa without exchanging the underlying principal amount. So that's all for this presentation. Thank you.